Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here again. Very good morning. Today will be the Wednesday, the 15th of May, 2024. So before we jump straight into our gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, or no financial advice for any investment product. Okay, give me a minute. I think the screen tends to be it's not moving, right? Okay, 1 second. Okay, I think the screen is not moving. Let me do a check again. Okay, it should be fine by now. My apologies. Okay, so I just flash out the disclaimer slides again. Okay, let me just do a check, make sure that it's moving as intended. Okay, good. Yeah, I think it's all is fine now. All right, so basically, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term technical outlook on the major stock indices, the major US dollar pairs, the two key commodities market, which is spot gold XAU/USD and West Texas crude oil. Let's have a recap what happened yesterday in terms of these cross-asset performance, the related key events and key macro data that could potentially has an impact on these movements as well. So let's start with the key macro data first. Okay, so key macro data yesterday, what we do have over here is we do have the release of this US PPI data, not so important as compared to today US CPI data. Later I'll touch on towards the end of this session where we highlight on what are the key data and key events to look out for today. So yesterday PPI data came in hotter than expected. So what about hotter than expected? If you look at the core PPI, that means that's excluding energy and food. Month-on-month basis, it actually came in at positive 0.5%, way above expectation of 0.2% month-on-month, and also above the previous month of March at negative 0.1%. So for the core year-on-year, it's also came above last month figure of 2.1%. That's for March. It came in at 2.4% year-on-year for April. So almost within consensus, but if you look at the trend, usually if you want to look at the trend of such economic data, we tend to look at more on the year-on-year basis, because year-on-year basis, it smooth out those erratic outliers that we tend to actually see on a month-on-month basis, right? So if you look at the year-on-year basis over here, okay, so what we could see over here is that very clearly there is actually a curvature since the low of December 1.8. All right, so you look at the 5-year trend, it seems to be that there's a very nice U-shape rebound that is taking place on the PPI year-on-year, core PPI year-on-year trend. So what it means that over here is that cost of goods in US is getting not cheaper but slightly more expensive. So that also boils down in line with last week where we shared with you all, or the start of this week we shared with you all, that potential stagflation scenario that could be at play in US, where some of the leading economic data, like last Friday, the preliminary May figure of the University of Michigan inflationary expectation data that inch up much higher, both on the 1-year and a 5-year basis, but coupled with so-called the consumer confidence that is plunging lower from a 6 months basis. That means, i.e., cost of goods going, business cost of goods going up, consumer inflation expectation going up, but however, consumer confidence is not picking up. That means potential slowdown in demand. So this is more like a stagflationary like scenario, which fundamentally speaking, it should be negative for risk assets classes fundamentally, because we know that in the stock market or in a market transacted assets, there tends to be sentiment involved, and sometimes sentiment override the fundamental aspect of uh, the intermarket correlate intermarket analysis correlation, where give rise to what we call that irrational behavior. But sometimes because of this sentiment factor is so significant that override the fundamental factor, we still got to pay respect to the sentiment factor while we are looking from a shorter term perspective when it comes to trading in the shorter term basis. That what we could see over here is that given this slew of what I call data, potential stagflationary data that is taking place in the United States, what we could see is that yesterday there's actually a Fed speak, none other than the boss over here. So what the boss say, Miss i.e. Fed Chair Powell over here, he's actually looking at a very similar tonality with his colleagues last week. That means he said that the Fed is likely to keep rates higher for longer. And also he do flag the lack of inflationary progress in the first quarter, which is by looking at this slew of latest data that is coming out. Okay, but one thing, kind of a consolidatory note is that he did mention over here, the Fed chief reiterated that it wasn't likely that the central bank next move will be a hike. So he give a bit of comfort saying that, hey, we know that inflation data is hotter than expected. There could be some form of stagflation risk, but at this point in time, he do not, in his opinion, he do not see a potential hike in the next step for the Federal Reserve monetary policy decision. So i.e. is either on hold for a longer period of time or at least one interest rate cut before 2024 ends. So that actually give a bit of consolidatory mode to the risk market as well. But most important, the risk market, that means we're talking about the performance of the US major stock indices, continue to rally yesterday despite this hotter than expected PPI data and that not so dovish Federal Reserve Powell Fed speak. Okay, if you look at the performance, a very strong push up after the second half of the US session, rallied to close to the session high. That's for the S&P 500. Similar movement on the Nasdaq 100 as well, and similar movement on the Dow Jones as well. And most importantly, the Russell 2000 actually outperformed with a gain of positive 1.14%. All right, and if you look at yesterday's uptick in the US stock market using the S&P 500 as a benchmark, if you look at the heat map, the intraday heat map of the P, what we could see over here is almost a slew of green and almost entire green in the mega cap 7 stocks, which is primarily driven by the big cap technology related company. Nvidia is up by positive 1%, Google plus 0.6%, Microsoft 0.69%, and even Apple 0.6% due to this ongoing potential tie-up with ChatGPT or Google Gemini to actually include these AI capability tools in Apple product pretty soon. All right, but what's interesting over here was this slew of AI initiative by ChatGPT. So we know that ChatGPT is a significant partner with Microsoft. So what happened over here is that ChatGPT actually launches a faster and cheaper AI model. Not ChatGPT, is OpenAI, pardon me. ChatGPT is the product of OpenAI. So what I do over here is that it's now doing a ChatGPT 4.0, not 0, is 4.0 Omni, which tends to be much more powerful than the previous suite of ChatGPT capabilities. All right, so i.e. now it could actually detect a picture and voices as well, and on that particular same day yesterday after it launches, its competitor Google actually also announced that it has Google Infusion search with AI in a fully revamped experience. All right. So yesterday, Google is launching a new AI infused search engine in your normal Google. Previously we type in Google, we just search. So now this Google search will be with AI capabilities. So probably something very similar with Microsoft Bing right now that is infused with their AI co-pilot that is powered by OpenAI ChatGPT. So that actually drives up the animal spirits in the US stock market. Why? Because you know that primarily focus the benchmark US stock market is heavily weighted towards all these technology stocks, which is now being driven. The next stage of growth is AI. All right. So with that, we got to actually respect this ongoing positive momentum that is having this feedback loop into the US stock market, despite of that stagflationary risk scenario that is still live. All right. At this point in time, momentum is taking over the risk asset classes. That means, i.e., infusing this kind of positive feedback loop into the major US stock market, not paying attention to the fundamental risk factor of stagflationary risk environment. And also, we got to mention over here, this more coming towards the second half of the year, is that this ongoing potential US-China trade war 2.0. Why? Because Biden yesterday just revealed a slew of new tariffs targeted on China imports to US. Okay, so this actually come on the brink of this ongoing much. I believe there is a replay of very likely between Biden and Trump. So in order for Biden to win the votes or win the populism vote to make America great again. So that was the tagline of Trump. He need to come up with such populism policy that target China. So China actually retaliated back yesterday, saying that, but they didn't give much detail. So China votes resolute measure after Biden's new tariffs. So if you look at the new tariffs over at my screen here, this is what they target. So we see a big increase in the tariff rate of semiconductor. 25% previously was slapped, now it's up to 50%. Electric vehicles was the most. So Biden administration now slapped 100% tariff on EV, because what they claim that China is actually flooding the entire world, including US, with their EV model. All right. So something to keep an eye watch for towards the second half of this year. I do believe that such rhetoric will start to be much more pronounced, especially both parties will try to gain votes during in the upcoming US election in November. But at this point in time, in the short term to medium term basis, positive momentum is still overriding all this potential negative impact that could be inflicted on the risk asset. That means, i.e., stock indices. All right. So what do I mean by this positive momentum? Is very clearly you could look at this particular screen over here. Let's share with you all. Where is it? Come on, come on. I think it should be this. Is it this? No. Okay, let me share with you all again. Okay, there's one particular chart I'd like to share with you all. This is not this chart. Okay, let me call up the chart again. This should be the chart. Okay, my apologies, because I initially opened the chart, so just now I just accidentally shut down the chart. Okay, yeah, this is the chart I'm looking at. So one of the plot over here, we know that in the US market is a very big, has a very big exchange traded fund. And within the exchange traded fund space, there is actually factor thematic ETF, not really purely on the S&P, but on the S&P 500 factors. That means on the bottom of my screen over here, what I did is that this S&P 500 momentum ETF. That means what the the ETF manager actually ranked the S&P 500 component stock only using the momentum factor. That means a very high momentum factor play component S&P will be inside this S&P 500 momentum ETF. And the manager, the ETF manager, also curated a quality ETF as well, which is the S&P 500 quality ETF. So this S&P 500 quality ETF ranks or taking stocks that has a higher value play. So we're talking about perhaps valuation is one of them. We look at potential debt ratio that is less by a certain extent. But nevertheless, I want to highlight over here is that the recent performance. So what I did over here is I get the spread between the S&P 500 momentum ETF divided by the S&P 500. So what we could see over here is that since March this year, the S&P momentum is been outperforming the S&P 500 index, right? So what we could see, and there's this bullish breakout by the previous major swing high of October 2022 and November 2020. There's this bullish breakout, retested again and rebound recently. So this is the weekly chart. So what we could see is that the last 3 weeks of performance on the S&P 500 is being driven by this momentum play instead, rather than quality play. So you look at the quality ETF divided by the S&P 500 is actually underperforming, can't break above this key resistance level that I drew. All right. So what we are seeing right now in the ongoing positive feedback loop that has taken shape in the US stock market in the last 3 weeks is being driven by positive momentum, as indicated by this outperformance of the momentum S&P momentum ETF over the S&P 500. So this is what I mean by momentum factor is overriding fundamental factor coming out from the stagflation scenario, coming out from Federal Reserve officials speaking that is less dovish, and as well as the potential US-China trade war 2.0 that is playing out in our eyes right now. Market is ignoring that. But if momentum is strong, we still got to respect this momentum until it's being exhausted from a technical point of view. All right. Now, the next key story over here is that I want to share with you is quite important is we know that the US Federal Reserve is getting less dovish. That means i.e. against the rest of the world. Bank of England last week has indicated to us that they are very likely to cut interest rate before the Fed, which is June this year or July, followed by the ECB as well, July or June. Okay, very clear portraying of their public speeches by their key officials in ECB and Bank of England. Then the next reason we got to ask ourselves is why the dollar strength is not coming back into the market in the last 1.5 weeks, because the dollar strength is not there. Because you look at the dollar index, like very quickly I share with you all, the dollar index over here is still stuck within, okay, 1 second. What is this? Okay, dollar index. Okay, the dollar index, yes, the trend, the medium-term uptrend is still up because it's still trading above the 50 and above the 200-day moving average and still trading above the key support of 104.90, which is the lower limit of this medium-term ascending channel that I drew from late December last year. Then we got ask ourselves, the dollar strength in the last 1.5 weeks is trading sideways. It can't break above the 20-day moving average at 105.73, and it also can't break down. So it's been sandwiched between 105.73 and 104.90. Okay, one of the reason over here is, like I say mentioned over here, is that this is due to momentum factor in this ongoing risk asset classes play. That means momentum factor playing out in the global stock market. So if you look at the current global stock market performance at this point, so this is a rolling 3-month performance as of now as we are speaking. Let me refresh it again. We start to see the top performer right now is not the major US stock indices. Yes, the major US stock indices, the S&P and the Nasdaq is still picking upwards, but what is actually outperforming them is the other country, we call it the other country ex-US stock market or stock indices, which is the Hang Seng Index that's up 22%, the German DAX that is up 12%, close to 12%, 11.8% to be precise, and also the German DAX managed to actually hit a fresh all-time high last week as well. Then even followed by China, then in fact the S&P actually underperformed against these three indices as well as the Nasdaq, and we see the dollar index going sideways. So what it means that over here is that potentially there could be a shift of short-term speculative flows from the US side of the story, the US stock market, plowing into this rest of the world major stock indices. So that could also cap US dollar strength on the not breaking up above a ceiling. That means being sandwiched between the 20-day moving average and the 50-day moving average. All right, so that could actually explain this ongoing, we call it desynchronization of the price action movement against the fundamental. So it's being led by momentum and flows. So that I hope that I could paint a clearer picture of what's going on in the global markets. All right, if we dissect this momentum, flow, and fundamental perspective, and which is actually overriding one another in a short to medium term basis. Okay, so with that in mind, so now let us now jump straight into the short term technical outlook of the individual asset classes that I share with you all. So let us start with the major US indices first. All right, the major the major stock indices, pardon me, not even, because we cover across the globe, not even the Nasdaq, on not only inclusive of the Nasdaq or the Dow Jones Industrial Average. So let's start with the Asia side of the story first. All right. So the Asia side of the story, let us start with the Nikkei 225, which is very important. Why? Because it's now shaping that potential bullish breakout already. So let me let me expand my screen so that you guys could see. Okay, so over here, what we could see over here is that yesterday we do have that bullish bias. Why? Because it refused to break below the bottom of this range support level at 38,010. We saw the 20-day moving average, and we look for a push up towards the upper limit of the range at 38,610, 38,930. So it really been made by this range. But based on the current price action and the current momentum, what you could see over here, the RSI clearly breaking above its parallel, key parallel former descending resistance. Breakout hit the overbought level. What at the overbought level, there is no signs of exhaustion. That means there's no bearish divergence, i.e. equal to trade at a higher high, and it now retests that pullback support level again. And also very similarly, the RSI on the price action also managed to hit a pullback of this former descending trend line, now turns into a pullback support that I drew from its previous all-time high on 22nd of March. Okay, so all in all, what we could see is a bullish breakout, potentially a start of a new impulsive sequence move to resume its medium-term and short-term uptrend phase on the Nikkei 225. So with this positive technical elements, we will still maintain that bullish bias on the Japan 225, but with the first support level to watch will be very close to this breakout point over here, the pullback of this breakout point, which is at 38,430, but I don't want to put it so tight at 38,430, still using this key previous former range support level at 38,010. So as long as it didn't break down below 38,010, we will still maintain that bullish bias on the Japan 225. First resistance now to watch will be, since this level has been surpassed, will be this swing high area of 7th of May. The minor swing area of 7th of May also conferencing with the 50-day moving average, I think as a resistance as well. 38,910 level, above 38,930 level, pardon me, exposes the next resistance at 39,130, 39,500, which is the congestion area over here of 15th of April and 11th of April, and as well as the golden ratio, the 61.8 Fibo retracement of that previous corrective down move from the all-time high of 22nd of March, pardon me, to the low of 19th of April. Okay, so that's sum up for the Nikkei 225, Japan 225 technical outlook. No change on the Hang Seng Index, i.e. the Hong Kong 33, going to actually trade within this short-term minor uptrend channel that I drew from the low of 2nd of May, still using the 18,680 as a short-term pivotal support level, maintain this ongoing short-term uptrend phase on the Hong Kong 33 index. Next resistance to watch 19,390. Above it exposes 19,980, which is the upper limit confluence with the upper limit of this minor ascending channel, and accepts the 1.618 Fibo extension from the low of 22nd of Jan, and confluencing with the minor congestion area over here as well from 1st of August last year. Only a break below this 18,680 will invalidate this bullish tone to see the start of another round of minor corrective pullback to expose the next support area at 18,250 and potentially even 18,000/17,900. German DAX, or the German 30, we call it in our platform. Still recall since Monday, we attempt to be bearish for that minor pullback. So that minor pullback scenario almost been made already. We do have a support at 18,700. Why is it made? Because at the end of yesterday's session, close to the mid of the towards the end of the European session, yeah, because that's towards the middle of the European session, it formed a bullish hammer and price action starts to rebound from here. And where it rebounded with that bullish hammer right at the 18,600 support that we highlighted yesterday as well. So more or less, this minor pullback scenario has already ended, and we may now be potentially seeing the start of another impulsive up move within its medium to uptrend phase. And momentum also positive as well. If you look at yesterday, the bounce managed to bounce off from a ascending trend line support that I drew from the RSI over here at this point in time. Okay, so all in all, flip back to a bullish bias on the German 30 given the birth of this new positive technical element in the short term on the hourly chart. For sure, 18,600 will be the key short-term pivotal support to maintain this, to revert to this bullish bias basis on the German 30. Resistance level to watch. First one, 18,910. Above exposes 19,030/19,070. A cluster of Fibo extension level at 1.382 and 2.618. Confluence with the upper limit of this ascending channel that I drew from 19th of April. Only a breakdown below 18,600 will revive that minor corrective pullback scenario again to see an extension to expose the next near-term support level at 18,470. Below it, potentially 18,320, which confluence with the former minor swing high of 24th of April, 29th of April, and as well as the lower limit of this minor ascending channel from the low of 19th of April, which is very close to the 20-day moving average, I think as a support as well. US Wall Street 30, Dow Jones continue to rebound right at the first support level that we highlighted yesterday at 39,230. So where it bounced off at the former upper limit of this ascending channel. So indicating to us potentially there could be a potential acceleration on the upside potentially, right, by the curvature of this retest and bounce off and forming an hourly positive Marabuzu candlestick yesterday. So very clearly no bearish exhaustion on the RSI. Why? Because the RSI also managed to shape a kind of a bullish breakout as well from here. All right, so net overall still maintain that bullish bias on the US Wall Street 30, i.e. Dow Jones Industrial Average Index DJIA, with a tightened key short-term pivotal support here at 39,230, which is very close to yesterday's low before the start of the US session. Resistance level to watch 39,775, followed by 40,020, which is the all-time high area over here. Only an hourly close below 39,230 will negate this bullish tone to kickstart another round of minor corrective pullback scenario to expose the next support area in short term at 39,050. Below it, 38,750, which is the congestion area over here, 3rd of May and 6th of May, and as well as confluencing with the 50-day moving average, I think, as a support. Then what we could see over here is the Nasdaq. So Nasdaq yesterday managed to continue to inch higher and almost hit the first resistance that we highlighted the day before, 18,380. So we still maintain that short-term bullish bias with a tightened key short-term pivotal support for today, 18,120, which is close to yesterday's minor swing low area, which previously tested this minor kind of a range resistance, tested, rebound, yesterday tested again and bounced. So for sure, this will be a key short-term support level to watch for today to maintain this ongoing short-term bullish bias ahead of the release of the US CPI data report later. Above 18,380 will expose the current all-time high area at 18,500. Only hourly close back below 18,120 will negate this bullish tone to see another round of kind of choppy minor corrective pullback, back towards the lower limit of this minor ascending channel that I drew from the low of 19th of April. Next support level to watch, 17,970, confluencing with the 50-day moving average acting as support. Below it exposes 17,810, which is the minor swing high area of former minor swing high area of 29th of April, and so coming very close to the 20-day moving average acting as a support level very closely to 17,810 as well in a couple of days time. So net overall, across the board, positive short-term positive technical elements in the major stock indices across the board. Now, FX markets. So like I mentioned, the US dollar is still stuck over here. So if you look at the dollar strength itself, based on a 5-day rolling performance of the dollar against the other major currency, so you see that the dollar is getting very, very weak against the rest of the major. The weakest now being the Aussie dollar. Why? Because Aussie dollar is very related to risk on play. So that aspect of it, the Aussie dollar is actually the dollar is actually the weakest against the Aussie dollar right now, but still remains firm against the dollar yen. So we've got to be very cautious right now on the dollar yen, because the dollar yen is not trading in line with the rest of other dollar major pair. Okay, based on this 5-day rolling performance chart that we're looking at it right now. So let's start with the European currency first over here. Wait, where is the dollar index? It should be here. Yep. Okay, so for the euro dollar, so euro dollar yesterday, the price broke up above the 1.08 short-term pivotal resistance, also the 200-day moving average, and also it broke above this kind of medium-term descending channel that is in place since the high of 28th of December last year. Okay, so potentially, right, if you look at from a daily basis right now, the euro dollar could be trapped inside this kind of symmetrical triangle range configuration since the high of 18th of July last year. All right, so it's like a symmetrical triangle range configuration. So potentially, right, the next upper limit will be somewhere around, from a medium term, not from a daily perspective, not from an intraday perspective, but from a, we're talking about a multi-month perspective or multi-week perspective. The next resistance level to watch will be at this 1.10 level, around the 1.10 level, which is the upper limit of this symmetrical triangle range configuration that it could be evolving right now, since the bullish breakout of this former medium-term descending channel that I drew from the high of 28th of December. So now back to the short-term technical outlook. So this is more of a medium-term, multi-week to multi-month outlook on the daily chart. So from here, very clearly, short-term, the bullish bias is back. Short-term intraday bullish bias back. Let me stress again, because it's a 1-hour chart. So with that, the first support level to watch will be at 1.08. So still remember that yesterday, yes, even though we flipped to a bearish bias, but we got to mention that it got to break down below this 1.0755 level. If it didn't break, the bearish bias will be not so pronounced. So indeed, there was actually a spike down during the European session yesterday, or before 1 hour before the start of the US session. So this spike down also potentially lead to that strong PPI data as well release. Then after that, market starts to push back up, ignoring the fundamentals. Okay, the more hotter PPI fundamental that by right should support a stronger US dollar. So we got to respect what the market is telling us, because especially if we are looking at things from a short-term perspective, because momentums tends to override fundamental. Okay. So what we see is that 1.0755, for sure, this will be the short-term pivotal support level. So this was yesterday's bearish breakdown level or the downside trigger level for yesterday. So downside trigger level becomes short-term pivotal support. So as long as this short-term pivotal support is not surpassed to the downside, euro dollar could potentially expose the next near-term resistance area at 1.0850, followed by 1.0880 in the first step in the shorter term. Only an hourly close back below 1.0755 will negate this short-term bullish tone on the euro dollar to see it reintegrate back into that range configuration again. Next support level to watch will be at 1.0730, which confluences with the 20-day moving average. Below it exposes the minor congestion area of 1st of May and 2nd of May, which is a support at 1.0680. Very similar for the sterling pound as well. So the pound actually, the sterling pound. So the sterling pound or the cable broke above that resistance level at 1.2560. invalidating this potential what I call head and shoulder formation, minor head and shoulder. So like I say, we do have a level for us to watch yesterday, which is the first support at 125 figure level. Only this level breakdown, we did mention that it will see a much more pronounced slide within its sideways range, but however, it didn't break down. It actually almost tested and staged that rebound and surpassed that short-term pivotal resistance yesterday at 1.2565. So this 1.2565 will be a first support level to watch for today, but I don't put it so tight. I will maintain yesterday's key level because that actually induces the V-shaped rally, the intraday V-shaped rally on the sterling dollar. So 1.25 figure level, short-term pivotal support level, flip to a short-term bullish bias on the sterling dollar. First resistance to watch 12640. Above it exposes 12685, 12710, which is the minor swing high area of 9 of August and 10 of August. Only an hourly close below 1.25 figure level will invalidate this short-term bullish bias on the sterling dollar to see another round of choppy move back into its very complex sideways range configuration again. Support level to watch after 1.25 will be 1.2460. A break below it exposes 1.2390 on the sterling dollar. So like I mentioned over here, the Aussie dollar is right now catching up the strongest against the dollar due to this risk-on behavior that's being seen across the board in the major stock indices that we highlighted earlier on. So very quickly, let us flip to the Aussie dollar. So Aussie dollar yesterday, we do highlight, we do have a first support level over here at this 0.58 65.85. So we did mention that unless you have a clear break below 65.85, then it could expose 65.50, 65.20. So what we see is that yesterday it did a bullish reversal hammer right at the test at that 65.85 level, which is i.e. telling us that the bullish short-term bullish momentum is coming back into the Aussie dollar, and where it retested the lower limit of this ascending channel as well. So all in all, right now we got to respect the momentum factor that is playing out in the Aussie dollar. So flip to a short-term bullish bias on the Aussie dollar within its medium-term symmetrical triangle scenario that is still unfolding. First resistance 66.45, above it 66.80. Right now it's actually breaking above it already. So 66.80, above 68.80, this will be the key medium term resistance of 67.20. All right, only an hourly close below 65.85 will negate this bullish tone to see another round of corrective decline unfolding. Minor corrective decline unfolding of the Aussie dollar to re-expose the next support level in near term at 65.50, 65.20, which confluence with the 20-day and the 200-day and the 50-day moving average also acting as a support as this zone as well. All right, so 67.30 is a very important level on a higher time horizon. Why? Because 67.30 is a key medium term resistance level, because the Aussie dollar, if you look at the on the hourly chart, is still trading within this symmetrical triangle range since the low of 13th of October. All right, and the top of the limit of this symmetrical range is now at 67.30. All right, so in short term, we are now looking if there's any signs of bullish bias at most 67.30 first in first step, and we see how the price action react from there from a technical analysis perspective. All right, dollar yen. So we do mention dollar yen to be cautious. Why? Because it's coming very close to our short-term resistance level, which we highlighted last week at 1570. So 1570 figure level, 157 figure level is the symmetrical, not sorry, the Fibo retracement of the golden ratio of 61.8% of that previous down move from 29th of April to 3rd of May. So this previous slide was actually more or less induced by the BOJ intervention as instructed by the Ministry of Finance, the Japanese Ministry of Finance, to actually sell dollar buy yen. And this 157 level also confluenced very closely to that previous level where it did that intraday breakdown as well, the steep intraday breakdown. When it break below that 157 level, then you see that boom, that slight thick shape. So for sure, this is a key level to watch. So given the fact that the dollar is not showing any strength against the rest of the currency as well, against the rest of the currency pair as well, we will be more cautious to err towards the bullish side of the dollar yen. So still no change as usual from yesterday, sticking to a neutrality stance on the dollar yen 157 155.90. Only a break below 155.90 potentially exposes the next support area at 155.26, which is the 20-day moving average. I think has a support level as well. Below it exposes 154/153.30, which is coming close to the upward sloping 50-day moving average. I think it's a support level. All right, so that's for the short-term technical outlook. Levels to watch, short-term technical levels to watch on the dollar yen. Spot gold XAU/USD for sure is also benefiting that stagflationary risk environment scenario, and as well as the weaker dollar in general that is playing out as well. Nice rebound off the short-term pivotal support level at 2,327, also the 20-day moving average, and as well as the lower limit of this minor ascending trend line that I drew from 3rd of May. So still no change, still using that 2,327 as my short-term pivotal support level. I do not want, because we can't tight it so much, so I don't put it so tight. So this will be, the first support level slightly above the pivotal support. Let me highlight this in blue. Okay, will be at 2,347. So 2,347 will be the first support level. I don't want to put it so tight, still remain at 2,327. As long as 2,327 holds in any potential pullback, we will still maintain that short-term recovery or bullish bias scenario that is taking shape in spot gold XAU after that multi-week corrective decline that has really been played out more or less. Why? Because it's a bullish breakout from a bullish descending wedge, indicating to us that this could be the potential start of a new impulsive upmove sequence within its short and medium term uptrend phase. Next, first resistance level to watch 2,378, a break above this level potentially exposes the all-time high area at 2,420. Only an hourly close below 2,327 will negate this bullish tone to see a potential another round of corrective pullback scenario to unfold to kind of expose the psychological level at 2,300. Below it, the key medium-term support area at 2,265/2,260, which is also conversing with the upward sloping 50-day moving average. West Texas Oil yesterday managed to survive again at the 78.40 key medium-term pivotal support level, which is also the lower limit of this minor descending, medium-term ascending channel that I drew from 30th of December last year. So yesterday, no daily close below 78.40. It closed at 78.57, and right now during the Asia session, it managed to stage another bounce off as well. So momentum seems to be coming back as well by this upward sloping daily RSI from its oversold region, but at the moment it's still kept below the 200-day moving average that is acting as a near-term support, near-term resistance level. Okay, this 200-day moving average over here, which is around 80.40 level. So that's why in short term, no change. So because it can't break above the 200-day moving average that is capping it, we will maintain that neutrality stance, that means a sideways stance again for West Texas Oil until it have a clear hourly close above 80.30, which is the 200-day moving average, I think, as a resistance level. Or very clearly, this is also a graphical minor range resistance as well that's being formed since 2nd of May. No change, neutrality stance between 80.30 using 8th of May swing low area slightly below the 78.40 level on an intraday basis, 77.50. So neutral between 80.30 and 77.50 on West Texas Oil for now. All right, so with that pretty much sum up the short-term technical outlook. So key data to watch for today in terms of the economic data for sure will be the US CPI data. Okay, so before we talk about US CPI data, early this morning, 9:30 a.m., the China Central Bank PBOC, as usual, no rush to actually promote or induce liquidity pumping into the into the Chinese economy, because the China top policymakers are still doing piecemeal basis stimulative policy instead. So they left one of their key benchmark interest rate, the 1-year medium-term lending facility rate, where major China banks that could actually borrow from the lending window from its central bank PBOC, they left it at 2.5%. So very likely next week, the prime rates will still remains the same as well. So the prime rates are actually rates tied on to corporate loans and housing loans. So what we have over here is we do have the, okay, this shouldn't be so important. Why? Because this is the second round of estimate for Eurozone GDP, Q2 GDP. Yeah, sorry, Q1 GDP, not Q2, pardon me, Q1 GDP. So this is a second estimate, not the first estimate. So that shouldn't be much of importance. Okay, so what's important over here is the industrial production for March year on year, which is new, coming out at 5 p.m. Singapore time. Then thereafter, this is the all important US core inflation rate data. So market will be paying attention to the services side of the services inflation, whether does it tick upwards. Why? Because if you look at the core inflation, let me share with you this it will be released at 8:30 p.m. So expectation is to slide down slightly to 3.6. All right. So if you look at the core inflation rate over here, that's excluding food and energy, it's slightly turning up from the previous. I mean, it's not platooning down as expected. It's turning up. It's flattish. I would say it's flattish. All right. So, but market now is expected to dip to 3.6% year on year, but that's a bit cautious. Be careful because it may not come out as expected. Given yesterday, core PPI surprise hotter on the upside. And want to highlight over here is the services inflation, which is also part of this core CPI. So it's a component of it. So if you look at the trend of the services inflation, which market is pretty much watching. So last month figure for March, it actually exploded up to 5.27%, and that was the highest level since August last year. Okay, so if you look at the trend, is very clearly turning up, like the one that we show in the core PPI data at the start of today's daily slow. So something to take an eye watch for. But I believe that if it surprised too much, if this is going to take up over here, we got to respect the ongoing positive momentum in the risk asset classes, so it may not have so much impact on the price action of the various cost asset classes, because the momentum factor right now is actually overriding fundamental as per se. All right, unless it starts to surprise very high to the upside. Let's say today data is still coming at 3 point, okay, okay, the previous data over here. Let me go down. Okay, so instead of surprising it around 5.3, it came in at what, 5.5 to 5.6. That could be a bit of a problem instead. All right, so other than that, let's have a quick glance again. What are the things to look out for? The calendar again, other than the CPI data. So I believe that we do have some federal officials speaking as well. Okay, we do have retail sales as well, which is important. So retail sales 8:30 p.m. same timing as the release of the core CPI data. So forecast is expecting to dip lower at 3.8% from 4%. So if you look at the retail sales trend year on year, okay, it's kind of healthy. Okay, slowly trading upwards, okay, churning, okay, but market right now is expecting a forecast much lower instead. All right, at 3.8 for retail sales. Okay, 3.8 for retail sales. Then after that, we do have the weekly crude oil stockpile for US, compiled by EIA, the energy agency, for the last week ending of May 10. Okay, so that's 10:30 p.m. Singapore time. And about there is, yeah, so there is actually two officials speaking. After that, early morning, 12 a.m., Fed Kaskastri, and as well as Fed Bowman. So Bowman and Kaskastri tends to be the one that is less dovish, even less dovish than Federal Reserve. Fed Chair Powell. So they will be speaking at 12 a.m. and 3:20 a.m. Singapore time. And with that, that also pretty much sum up. And what we have is that we do have a key Japan data. So this is the first reading of their Q1 preliminary data that is out at 7:50 a.m. Singapore time. All right, and at 9:30 a.m. we do have a job number, employment change for Australia as well. So something to look out for tomorrow early morning before the start of our daily dose. And that's sum up for today's daily dose of market insights. So with that, I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.